Divorce happens in 50% of all marriages in this country. Chances are you don't want to be in partnership with your ex-spouse, or worse, in partnership with your partner's ex-spouse. And what we're going to do here is we're going to talk about how you handle divorce before it happens, so that it doesn't blow up a business. In my experience, I actually watched a family business here in San Diego blow up. One of the only businesses I've been involved with that actually blew up, and it blew up because of a divorce. It blew up because we didn't have a contingency plan in the buy-sell for what happens if someone gets divorced. So let's take a look at how we handle divorce. We handle divorce through the contract, and this is either going to be a buy-sell agreement standalone, or it's going to be in the operating agreement somewhere in there, and you're going to handle this in a way where you say what happens if you get divorced. And the single rule that you need to follow in this is that the divorcee is not entitled to the business interest as part of their marital property. What that means is that if you get divorced, even if you split it 50-50 or 60-40 or whoever gets what, you can't have the business interest be one of the assets that goes. Which means one of two things is going to happen. One, they have enough assets. They have assets to satisfy the divorce. Number two, they don't. If they don't, then you're going to trigger a buyout of that individual's interest to the extent that you need it to satisfy the assets inside of the divorce agreement. So, why are we going to do that buyout? Well, you're going to do it the same way we do all other buyouts. You're going to have a valuation formula. Once again, I like 3 to 5 times earnings plus your net equity. Then you're going to end up going and buying that out. And you're going to buy it out over a 10-year period of time. Why 10 years? Is because you need that stretch in time to be able to pay it out without running out of cash. If you pushed it to 5 years, chances are you're actually going to run out of cash in your business. Because every dollar you make, 50 cents goes to the IRS, and the other 50 cents then can go towards a buyout. And so it's a 10-year note at prime as your interest rate. And this is your simple formula. Now, if someone gets divorced, if your partner gets divorced, if you get divorced, you've preserved the business, you've made sure that it's a safe and easy transition to the other partner, and or made sure that you're not in business with your partner's ex-spouse, and you've solved the third D, divorce, in the 4 Ds of the buy-sell agreements.